Right, this one's a bit of a summary of I guess, the beginner's course, right? The kind of the starting point, the starting block. I wanted to I guess, kind of refresh some of these things and kind of bring them back to life in terms of where they are, what they are. So whether you've been with us for a couple of years or whether you're relatively new, this is kind of the starting point, right? So when you first join, or if you're still trying to figure some of these things out, initially start off with the beginner's course and just kind of follow the process through, right? Just kind of step by step. Even if you've already got a good grasp on the bigger picture, you've already got some experience behind you. Understanding how these techniques and tools fit together is going to help you a lot kind of going forward, right? So what I want to do is just cover kind of each of these individual videos, just kind of put a little bit of a wrap around them, and then the next two videos as part of this new tab will actually be kind of more in depth, more kind of advanced for that. But again, you'll still need to watch those videos kind of individually. It's not going to be the kind of the one video solution. All right. So with that being said, in terms of the very first video, right now, the market is pretty much personal to each individual, right? So there's not going to be a best tool, best instrument. It's what works for you, what kind of fits with your day job, what works in terms of what you're looking for, what level of interest you have in something. I know some of you guys would have turned up here with a view of just trading crypto. Others, obviously, stocks is the main kind of play. And outside of that, my bread and butter, and Paul pretty much the same, is we trade Forex, right? Now, again, there's no best solution. It's the best solution for you. If you look at things like, say, alts in terms of crypto, a lot of these things haven't really evolved to a point where the professional kind of money makers, market makers, are actually looking at these, right? So some of the techniques such as Elliott waves and Wyckoff, they'll work from time to time, and it'll feel like this incredible, this has happened and that's happened, there we go. But in the grand scheme of things, the market itself is maturing, right? So just keep that in mind in terms of trying to think about and to look at what it is you're actually interested in, right? So next video, um, types of analysis. Now, this technically is broken into three, right? You have the fundamental analysis, you have technical analysis, and then there's the sentiment analysis, right? Now, what we teach, what we use, is almost a combo between, I guess, the three. Very driven by the technical analysis, with a little bit of an understanding as to what's going on, bigger picture, what the sentiment from the market is looking like, what the bigger players are actually seeing. And I think this is where a lot of people get kind of confused and mixed up, right? In particular, when you look at something like COT data, this isn't this goes on for now and next week it's changed. Unless we get crossovers in the market and the conditions, these things are months and months and months on end. These things could even be years on end, right? So these are the types of analysis that you can break it down into these three kind of subcategories. Now, again, let's use alts and stock and kind of put them into the same bracket. If I was going to go and trade altcoins, I was going to go and trade stocks, probably start with the fundamentals, right? So the fundamentals give you a kind of a picture, a snapshot of the kind of condition of the company as such. This could be anything from founders, financing background, could be new clients, all this type of information. Then you have in terms of sentiment. Now, whether they're kind of open to pump and dump schemes, even things like Tesla or Nvidia, you can see the crowd sentiment right from miles and miles away. So again, kind of combining the two areas there. And then when you come into that technical analysis, I'd put less emphasis on something that's less established. So again, an altcoin, less technical analysis, and obviously something well established, i.e., forex. The the whole kind of point would ultimately be, technical more than what the fundamentals are saying. All right. Now, next one, selected a broker. Now, this one is always an awkward one, right? And I know a lot of people, especially with smaller accounts, you'll be looking at this and thinking to yourself, you want to go with the cheapest that you find, right? You want to go, what's the best? What's the cheapest? Now, this is where these affiliates and obviously influencers just in general, these will give you things like a 50% sign up bonus. You deposit 5 grand, they'll give you 5 grand in some instances, right? So the big question you need to ask always is, where's that additional money? Where's that additional funding coming from, right? Chances are you're very unlikely to see, that money again, right? And the reason for that is 90% of traders lose 90% of their money in 90 days. So our kind of advice to you is, when you're looking at brokers or exchanges, don't look for the cheapest. Look for, even down to the jurisdiction where these guys are based. Does it fit in terms of, your country of residence, or even just places that you understand some of the rules and regulation. I'm not saying you have to be, a kind of a lawyer degree, kind of level in terms of understanding these. But if you're going to use, a US based company and you're kind of situated in the US, the chances are, if something goes wrong, the whole point of being regulated in the US was, you've got someone to kind of pick up the phone to, right? You've got someone to complain to. If you're going to go and use a company that's registered in the Seychelles, and they end up closing down, they end up kind of, taking your stop loss out, and off you go. It's, where are you going in terms of making that complaint? How are you going to track that money, or, the issue itself? Okay. So very similar in terms of something like a prop firm. If you use a prop firm, or you want to use a prop firm, start with some of the big boys, right? People like FTMO. These guys have been well established. There's track record in terms of payouts and payments. And I know, unfortunately, these guys no longer offer services in the US, but there are other companies, right? So again, don't look for cheap. Don't look for, oh, this is the best deal. Look for the bigger picture, right? And that's the only thing I can say in terms of the broker or brokers. Now, trend lines, right? Now, what I want to do is, although this isn't the kind of a lesson, this is more of a summary. I just want to show you a very quick, simple way that I use in terms of a trend line, right? Now, this can lead me on to things like moving averages and so on. But in the grand scheme of things, right, I can see that the momentum is moving up here. The momentum is moving down here, right? So let's start with something like this, and then we come down this, right? So I've gone obviously underneath on the way up and on top on the way back down, okay? So when it comes to a trend line, quickest, easiest, simplest route for me is, I will take the extreme low. I will swing this out, put the magnet tool on there. I will swing this out, right? Actually, I think I've just clicked. Let me just take that back. I've just clicked on the high there, right? And then ultimately, I will swing this out until something touches, right? So that one there means that technically, right, on a trend line kind of potential, we weren't really in the downtrend until we break this level, right? So there's probably the drop and the retest of that kind of zone, right? Now, this one's probably a pretty bad example. The example that I wanted to show, and the reason for showing it this way, is pretty much like the two to the left and two to the right, which I'll cover just in a second, is, keeping a trend line simple, right, is just magnetize in the top. I'll turn the magnet back off. Obviously, you can press CTRL on the keyboard. I'm just going to drag it out. I'm going to swing it around until something touches, right? And that's good enough for me in terms of, a trend. I don't need 3 touches. I don't need 15 touches. Just very simplistic, right? It's a very easy mechanical way of putting trend lines on the chart, right? And what I'll do in the next video, or the one after, I'll be talking a little bit more and putting a bit more emphasis on the mechanical type of setups and structures, right? Now, again, if you've watched any of those videos recently on YouTube, you might be confused thinking, oh, well, that's not Elliott and that's not Wyckoff. And the truth of the matter is, you're kind of going into a smaller degree, right? So Wyckoff, Elliott, for me, they're still there in the background. I'm still taking the sentiment and the bigger picture, but I'm kind of distilling that down in terms of my just directional bias, right? So again, I'll explain that a little bit more in the next couple of videos. So before touching on moving averages, right, I'm just going to explain the 2 to the left, 2 to the right rule. So let's take this extreme high, right? I'm going to zoom right in on the candles in a second, right? But what I'm looking for is, I'm looking for the extremes of the wicks, right? And I'm always going to be looking for the, the highs and the lows of the candle, not the body. And the general idea is if I zoom in, right, and I'm going to come up and check, obviously, the high here, right, at this particular point, because these two are very comparable in size. So we have this one here at 1.60194, and we have this one here at 1.6038, right? So that's obviously 19. This is 38. So for me, the way I'm seeing this is here's my high. Okay. Now, what I mean by two to the left and two to the right, it's just a very simple and again very mechanical way, right, of basically understanding how to replicate the process. If I go to this high, I look two to the left, which is this candle and this candle. Is this still my extreme high? Yes, it is. It's two to my left. If I look two to the right, one, two, is this still my extreme high? Yes, it is. Right. So there's my tick in the box. Two to the left, two to the right. There's my high. As I come down for the low, right now, I can see straight away this one's more obvious. There's the low. Two to the left. Yes, it is. Two to the right. Yes, it is. Right. So there's my swing low. Then ultimately coming back up. If I go one candle to the left, two candles to the left, this one is my swing high, two to the right, this is my swing high, yes. Right, and I'm following that process. So some of these you'll almost see me ignore, right? So again, just doing this very quick, two to the left, two to the right, yes we are, right? Now, obviously the next thing is when I come up here, this little red one, two to the left, yes it is, two to the right, no it's not. So I'm just following that logic up until here, where two to the left is okay, two to the right, okay, right? Now, the reason that this, like pretty much like the trend line, is simple, right? It's very easy to follow, very easy to understand, and that is the only rule, right? So for me, if I'm looking at this saying, oh, well, should I count this in here, and am I making my zigzag look something like this? Well, no, it doesn't fit my criteria, and therefore my zigzag brings me all the way up there, okay? So at this particular point, it's something that you can copy, paste, repeat into any time frame, any chart, any price action. And that's the whole point in terms of the mechanical process. Okay. Now, next one, moving averages, right? Now, a lot of brokers will be throwing moving averages at you. Most of their charting packages will include, a 200 moving average and a 50 moving average almost as a given. A lot of people trade, what they call the golden cross, and there's not really that much value to it. It's almost this kind of self-fulfilling prophecy. It works sometimes and other times it doesn't, right? Now, what I'm looking at is, we can see that this is moving down, right? So if you were to stick a 200-day moving average, are we under or are we above? Well, of course we're underneath, right? We're moving down, and we have done since 2009, right? So at this particular point, I don't really want to be going into, again, the technical details, right? It's something that if you like them, use them. Is there any value to it? Not really. If you want to ask me a question on it, I'm just not interested, right? In the grand scheme of things, if you see a moving average, you're using a moving average, right? That's fine if that's your strategy, right? But it's not something that we use. It's not something that we teach. The only place really, I know Paul uses the moving average on the volume tool, right? So if you put the volume kind of down below, you can actually come into the settings, and you can use obviously the volume moving average just to see if volume is picked up over any period of time, right? But I personally, I don't use that. Not interested. For me, you can see that kind of visually. I'm looking for momentum in terms of volume growth at the kind of the right places. All right. So again, without being too technical, without going into too much depth, that's ultimately covering the trend lines, moving averages, two to the left and two to the right. Supply and demand. So supply and demand, right, is again very, very straightforward, right? And this is where you can kind of make this mechanical, right? So I'll cover this picture in the next stream. I'm going to use this last bit of price action, right? And obviously this goes back to 2001, right? So you're talking, 13, nearly 14 years worth of data. And all I'm seeing, and the reason that I want to show this, is that when the price come down to this region, right, we started consolidating. As we consolidated, we then broke out, right? We got a little tiny pullback, and then we accelerated, changing all of the character from being a downtrend to an uptrend. Okay, so this little box, you will hear me refer to things like this as an auction area, right? This is where the buyers and the sellers were arguing over price. The chances are, right, you could tag this as a major zone in terms of demand pushing price up, right? There was interest to buy, which is the demand for the product, the stock, the item, the article, the instrument, right? Whatever the tool that you're using, there was obviously a demand that stepped into the market, right? Obviously, supply had kind of run out, demand comes in, and we push away. Now, at this particular point, I'm looking at a couple of things, right? You've got the last couple of candles, which is what I would regard as the final kind of sells before you buys, right? You could use the very last candle, or we could use the whole block, right? Again, no wrong, no right. It's ultimately down to you in terms of the process. You could argue this on a time frame. If I'm looking at a monthly time frame and I'm looking at price action back in 2001, you could argue that the big box is big enough that when the price was all the way up there, if we knew that we were coming back for, a move back down to where that demand was, then we know that the box is a pretty big target, a broad target to target for, right? As you then get closer and closer and closer in terms of time frames, there's nothing stopping you refining that in terms of one candle, the last sell before the buy, the last buy before the sell, right? So what I'm then looking at, right, is just to give an example. All I do is, again, I use the magnet tool. I'm going to come to the last buy here, right, before the sell, and I'm going to drag my box, all right? So as you can see, I've gone to that green candle up the top, and I'm going to use the last red candle there, right, at the bottom. And that's really what I'm seeing in terms of larger picture supply demand, right? These are the external supply demand. Now, obviously, you can do the same thing. We can do the same thing here. Take the magnet back off. We can do the same thing there, right? What happens then is price comes back, right? It fails to come into this supply. We push away, making a new low, which ultimately brings us to another area of interest. This last candle here, or this last green candle here. Price comes back, and this time comes back into that green candle range, right? And almost confirming the rejection, okay? Now, the only issue here for me is if we were to build our supply demand down here, demand come back in, right? At this point, it failed to make a new high, right? We failed to make a new low, which means we were technically range bound in this period as well, right? And again, mechanically speaking, if you follow that logic through, it will be the same every single time, every single process, right? The only thing that changes it for me is if this one, for example, this last little red candle in there, this pushed the price up, right? Which means that's a strong point for the future, right? And as you can see over here, last red candle in there, right? This one becomes a weak one because we failed to make a new high, okay? So now what you'd expect is price to fall through this because the demand had run out, okay? So at that point, then, it's the same process, the very same technique, and it's something that you can repeat. Okay. So that's the last bit in terms of now, like I said, I'm not trying to do too much detail for this one. This isn't a kind of a one video solves all the problems or solves, all the not needing to watch the other videos. So back testing, right? So what I've just covered with trend lines, what I've covered in terms of even moving averages, what I've covered with the the buy before you sells and the sell before you buy, the two candles to the left and two candles to the right. This is where now you want to be back testing, right? Now you don't need software or anything fancy in terms of back testing. Back testing could literally be get a notepad, get a pen, and just go through two or three instruments, right? Now, if you're interested in crypto, maybe use Bitcoin. But in addition to that, start looking at something like gold, start looking at something like a Forex pair, and do two or three in terms of understanding how these markets move, right? How the dynamics move. Test whether it's your strategy or test the concepts. And then at that particular point, you're going to have some kind of, right, this worked this time, it didn't work next time. And you're going to start to see patterns and behaviors in, what you're actually analyzing. Right now, psychology, this is the last one in terms of this particular video. And again, coming back to why mechanical, what the mechanical kind of terminology actually means and represents, is that by having a process that you can repeat over and over and over again, understanding the level of risk that you're putting into any kind of trade or any situation, it means that even when you're wrong, you've lost a 1% deal, right? And that's pretty much, that's the worst that can happen, right? Now, when obviously you're right, you're going to be in a position that you've refined your entries, you've refined the techniques and the kind of capabilities that you should be looking for a 3-to-1 in terms of the reward to that risk, or greater, right? Now, at this particular point, it becomes very, very easy in terms of moving forward and making progress, right? Now, if you've come to us and you've joined as kind of a crypto, a crypto trader, the one thing that I will say to finish this with, right, is it's the kind of copy paste repeat kind of methodology. When Bitcoin goes from 15K to 30K, great. Bitcoin goes from 30K to 60K, great. Bitcoin goes from 60K, you still need 120 for you to be doubling your money, right? And obviously, as that kind of goes, that exponential kind of growth, the time horizon becomes greater. So the issue that you have when you are only thinking in those terms is you're investing, not trading. And then the reality is it becomes an awful lot harder to repeat the process, day in, week in, over and over again on multiple occasions, right? When you look at the psychology and the logic behind the market in general, your emotions and managing your emotions, you get people that come to me and they say, "Oh, I've lost 50% of my account," and you think to yourself, how can you lose 50% of your account? That's 70 trades plus. You should be losing your account to that degree, not one trade. And this is the difference in the mindset, right? So to flip this on its head, if you were to follow the prop firm account and the prop channel kind of methodology, for example, you should be looking at that one risk to a 3+ reward. You're only committing a partial amount to the account until you've actually gone and passed to the challenge. You then receive your funds back, which means technically you're trading it now for free. Okay. Now at this point, this changes the mentality, the mindset, the momentum. And at that stage, then, if you're only ever looking for your 3-to-1 type trades or greater, you're always moving forward, right? It's week in, week out, week in, week out, right? And that ultimately is a big, big factor in terms of psychology. The one thing for me that I see a lot, and a lot of people fail with this, and again, it comes back to kind of the whole crypto notion, is, oh, well, if you've bought in at 30K, you're unwilling to sell at 60K in case it goes higher. You're unwilling to sell at 90K in case it goes higher. You're unwilling to sell at 100K in case it goes higher. And then ultimately, those kind of paper gains can quickly slip away if that price was to slip back down, right? So again, being in a position where you understand the logic behind it, no, I guess the difference between the trading and the investing side of this is it's something that you need to be able to do over and over and over again, right? And that ultimately is thinking like a professional trader. If you have, you have a bad losing day, you close your laptop, come back tomorrow, and tomorrow's another day, right? And that's kind of the point, is you don't want that, oh, well, the market has been since, 2001 through to 2024, market's been underneath the previous peaks, and you're kind of carrying those red bags through, not making money for, 3 years plus, right? Now, that's the difference in terms of trading professionally and trading almost as a hobby, as a sideline gig, and keeping your 9 to 5. And it doesn't mean that you have to finish your 9 to 5 to trade more professionally in terms of the gains and the earnings, but you need to be thinking more, which is why this kind of finishes off with this psychology. All right, so anyway, I'll be doing the next video hopefully straight after this, right? I got a bit of time, and yeah, sometimes it's easier when it's just set up. So hope you enjoyed, and I will see you in the next video. Again, don't forget to keep watching all of these, right? And make sure you make a point of watching these. If you've signed up, whether it's an annual, whether it's a lifetime, then you've obviously got the time to, go through these in a bit more depth. All right. Cheers, guys. Thanks for watching.